Good afternoon, everyone, and thank you very much for joining our mid-year markets outlook and summary. My name is Anthony Palmer, Group Commercial Director for Carrick, and I'm joined by Rob Enslin, Portfolio Manager for Linked Investment Managers. It's nice to report to you with a bit of an upbeat outlook. We have had a good start to the year, and Rob's going to unpack for us what's happened in this last 6 months. And off the back of a tough 2022, it is, I must say, pretty refreshing. So, Rob, over to you.
Yeah, thanks, Ant, and welcome to all the listeners. I would absolutely agree with you. 2022 was a tough year, a tough environment for most investors. I think, as we've highlighted throughout last year at our webinars, what made 2022 challenging was not the fact that equities necessarily had a tough environment, but that bonds also were under significant pressure, which meant for the average investor in a cautious or balanced solution, there wasn't much room to hide. But thankfully, 2023 has got off to a better footing. Part of what we've seen throughout the year is, at some point in time, valuations still matter, and valuations have become cheap. And as 2023 has played out, and certainly central banks, etc., expectations have eased. You've also seen some recovery in your investments. As always mentioned, I think we do need to remain long-term investors. Market volatility and uncertainty will continue, and there's certainly a lot of things to think about going into the second half of 2023. But be it as it may, the markets have certainly, as I mentioned, started off the year a lot more positively. So the topic of our mid-year market outlook is titled "Growth Still Remains the Focus." And throughout last year, we ran the title of "Growth Becoming the Focus." So it's really just a little bit of a transition from that conversation. But what we're getting at is that, we've gone through a significant interest rate hiking regime throughout the world, particularly in developed markets. I think they haven't witnessed inflation to this extent, and therefore the follow-through of interest rates in over 40 years. And ultimately, as we're starting to get to the end of the inflation sort of concern, what we need to start thinking about going forward is what growth globally starts to look like. I mean, economically speaking, there's typically a 12 to 18 month lag. When you put an interest rate hike through today, it's felt economically 12 to 18 months time. So far, this year's actually probably played out to the upside on the growth side of things. But yeah, it's certainly a question mark that's still unanswered, and hence the title of our mid-year outlook. But with that, I'm going to just jump straight into recapping the big picture. And to paint the scene, I think a few things are important. First and foremost, when we sort of this time last year, maybe a little earlier, but in the sort of April period, we saw inflation last year really accelerate. And that debate, the two schools of thought, some referring to inflation likely to still be transitory. For those of you still not clear what I mean by that, the expectation was that inflation was going to ultimately roll over, and there was a short period of time of high inflation, versus the other camp suggesting that it's a more structural. By about this time last year, it became quite evident that inflation was a serious issue. And with that, we really saw central banks also buy into that issue and hike interest rates at the fastest pace on record. Now, fast forward between 12 and sort of 18 months from that point in time, and we would argue that we're getting much closer to an inflection point. So we're not suggesting by any means that inflation's gone, but we certainly believe that most central banks have got hold of inflation, dealt with it quite significantly through that interest rates. And whether we see one or two more hikes or even three, it's less important as what it was a year ago, because a year ago, the market was underestimating inflation and therefore what central banks were going to do. Whereas at this point in time, it's very much in the price. We might get a surprise fringe difference here and there, but by and large, we would argue that's behind us. Secondly, with that, somewhere along the year, and certainly was the consensus view at the beginning of this year, was that we were going to see some fallout in economic growth. Now, a lot of the economic data that is coming out across the world is showing signs of slowing. However, slowing less severely than what we were initially anticipating. So I think that's a positive. And that debate whether we're going to see a hard landing, i.e. a real strong fallout of economic activity versus a soft landing, is probably swayed a little in favor of that soft landing outcome, which is really the Goldilocks outcome that I think markets were hoping for, where central banks were able to deal with inflation through higher interest rates, but not at the complete sellout or fallout of economic activity. If we had to look at 2023 so far this year, I suppose the two big surprises in our minds was first and foremost the China reopening trade. China, as we've been well documented, went into COVID a bit later. They were in lockdown while the rest of the world was sort of reopening their economic activity. And towards the end of last year, early this year, they've reopened their economy. And the expectation was that we were going to see sort of a carbon copy play out like we've seen in developed markets, where that pent-up demand comes through. You see like a rush of economic activity and even some degree inflation. And it's probably fair to say that China is underwhelmed in terms of that viewpoint. For people who had over allocated to emerging market themes are probably sitting a little disappointed at this point in time, because developed markets have actually outperformed emerging markets year to date. And then on the other side, the surprise from our perspective has been how persistently strong the dollar has remained. The dollar's really been in a strong bull cycle for some time now, accentuated by interest rate differentials between developed market economies. But at some point in time, it just really felt, or it feels still, that the dollar is potentially a little overstretched relative to a trade-weighted basket of other currencies. But that has really held up. Maybe the last month to date, you've seen some easing of the dollar, the first signs of potential dollar weakness. But if we take the sort of broader year-to-date view, that dollar strength was on the positive side a surprise. Keeping and sort of taking a little bit more of a forward-look view, the environment we're in right now is a really tricky one for earnings visibility. Because you've got different push and pull factors working against corporates. On the one hand, you've got this fear of slowing growth and what's that going to do to your sort of demand for product. And then on the other side of the equation is that despite inflation slowly easing over time, it's still in absolute terms higher than average. And a lot of the economic or the corporate earnings that we're going to be seeing, and we in an earnings reporting season right now, are backward looking, and they have those higher inflation numbers in them. Now, certain industries are able to deal with inflation better than others. Industries that are able to pass on inflation quite easily have been net beneficiaries of this. Classic example would be something like Visa. It's really just a function of number of transactions that take place. So in a higher inflation environment, Visa's ability to just actually charge a higher fee based on their transaction cost has actually been a beneficiary, where other industries where there's an input cost to what they produce, they've obviously seen some margin squeeze in that regard. The Walmarts of the world have spoken about that higher operating costs environment. But be it as it may, as we look forward over the next 12 months, I would argue earnings visibility is challenging. And therefore, in terms of our thoughts, we're preferring to invest with managers that tend to have more of a quality bias, because the type of companies, underlying companies that those managers are investing in are often a lot more sort of higher or mature businesses with an economic moat around them, and the predictability of their earnings is just a bit clearer. So that's a little bit where our thought processes are on that. In terms of fixed income, and we'll show some slides shortly, but fixed income has probably been the biggest winner over the last little period. I mean, we've been in a very long period, over a decade or so, where fixed income was more about the capital appreciation through yields coming down. And we ultimately got to a point in time where, yields were close to zero, and there was not much more capital appreciation to be had if you looked at the dynamics of the bond market. Because of high inflation and the speed at which central banks have hiked interest rates, last year, really hard environment for investors. But at this point in time, suddenly fixed income is a far more attractive or relatively attractive asset class than it's been for, as I said, over a decade, and has an important role to play in your portfolios. I mean, a very broad brushstroke, but we're looking at sort of 4 to 6, even 7% yields, depending on what fixed income side of the market one is investing in. And then should we go into a slowdown that ends up being worse, there's the potential for that capital appreciation offset as interest rates start pricing down. So that's an interesting asset class, and certainly one that we're finding a lot easier to construct a portfolio, a well-balanced portfolio from. But one point we just want to make aware is that there needs to be some degree of thought when investing in fixed income. We feel that certain credit spreads aren't necessarily reflecting or giving investors enough of a spread for the inherent or potential risk of an economic slowdown. So we're tending to focus more on the sovereigns and investment grade and avoiding the high yield debt side of the market. In terms of everything that I've just said, I'm painting a picture of a world that might be slowing, or certainly that's something we need to be wary of. But counter-cyclical to all of that has been the emergence of artificial intelligence. Now, artificial intelligence didn't just arrive this year, but I think the average Joe on the street got the first-hand experience with ChatGPT showing the power that AI can bring to the world that we live in. And it certainly has the potential to be counter-cyclical, as I mentioned there, in the sense that despite whatever's happening economically, the drive behind that can outweigh all of those economic slowdowns. And just to give you a sense of how companies are going to potentially be able to monetize in this space, if we take Microsoft last night, or not last week, announcing their autopilot project, there's about 1.2 billion users of Microsoft. So let's use a rough number and suggest that 20% ultimately take up this artificial intelligence package. It's priced at $30 per user. You're looking north of 90 billion revenue, additional revenue that a company like Microsoft's able to earn as a result of artificial intelligence. Still very early days, and I think there's going to be a lot of speculation and even to some extent, overhyped businesses that are overpriced and underpromised. But by and large, we think it's a big development that has transpired over the last sort of 12 months or so, and something I think exciting new leg for those growth industry business models. And then finally, and then we'll move on to a couple of slides, just sort of unpacking some of these points. The world we're living in, if we take sort of a 18-month, even a 36-month view of what's happened, the need for investor to be active has almost been heightened in this environment because things have changed as quickly as they have. We've gone from sort of where interest rates were to almost record low interest rates, and then up to interest rates never seen in the last 20 years or so. So within that journey that we've gone through, there's the need to actively manage your portfolio has been essential and make those adjustments. So typically, we've always said you don't want to trade. Trading for trading's sake drives fees up and therefore reduces performance. But there is a point in time where one needs to weigh up those risks in the portfolio that emerge as well as the opportunities and pair them up. So trading activity has probably been a bit higher in portfolios over the last 18 months. I do suspect once sort of the inflation and interest rates cycle starts to ease, that might stabilize, but just something for the listeners to be aware of. I think this is more a theoretical step back of the world that we're living in, but it's worthwhile just debating a little bit in detail. And the point here is that it hasn't been an easy task for governments and central banks over the last couple of years. And we certainly feel like they're walking a tightrope as things have come to a head over time. I think in one sense, you've seen financial instability creep into the market to some extent. As you've raised interest rates at the speed we have. Sort of tangible examples of that is the banking crisis that we witnessed in regional banks in the US around March this year, and then the fallout of Credit Suisse are all examples of, when you put pressure on the financial system to various forms, but in this case, higher interest rates, there are some fallouts, and there is still that potential going forward of those types of risks. I mean, I think it's been widely documented by anyone who's traveled to Europe about the cost of living and the cost of refinancing your home loan as an example of how those sort of the impact or financial instability has crept into different pockets of the market. We've also seen quite a polarization of the status quo of how the world has worked. Over the last 50 years or so, we've lived in a generally friendly, harmonious type environment, but with the combination of Russia's invasion of Ukraine, you might even put COVID, and the dynamics of all of those things together has meant that you've seen on the one hand, NATO find strength again and unity through the introduction of some new members and certainly the risk imposed in Europe. And then on the other side, you've seen the BRICS rally. There's a lot more conversation about the BRICS nations, conferences, and potential invites of new members to the BRICS alliance. So that's an example of a world that has moved away from that sort of very friendly backdrop, and that is a long-term risk that we need to be aware of. We know that US elections are coming up. If we look at the polls, it's still a long way to go, but as it stands right now, within the Republican camp, you've certainly seen a favoring of Donald Trump by a long margin compared to DeSantis. So we all know what Donald Trump brings, and in the environment we're in right now, certainly something to be concerned about. Should he be elected leader, regardless of what your views are, he's within this very fragile environment, a potential risk. Climate change also, I mean, front of mind, we've heard a lot about it, but it comes at a very challenging time in the world because on the one hand, I think it's fair to say global warming is a real thing. We've seen record levels of temperatures in Europe in recent weeks. And then to the same extent, you've had snow in places that haven't had snow in many years and floods in the US. But whilst we're trying to deal with climate change, we're also trying to deal with energy security. So the two are almost in conflict with one another at this point in time, and does create some issues in that regard. And then lastly, marginalized societies. We're seeing the rich become richer and the poor continue to remain poor. And that disproportionate allocation of capital leads to various threats towards markets. We've seen the Arab Spring uprising a couple of years ago, but those are all examples of how the elastic band has been stretched as far as it has and does pose longer term things to think about in your portfolios and portfolio construction. I'm going to pause there for a second and ask Ant anything that you want me just to chat about, or we'll move on.
Thanks, Rob. I mean, you're making some very, very valid points and broad points, and it always goes to show that there's always something going on in the markets, many moving parts, and in my mind, just emphasizes the value of having a diversified portfolio. I know we talk about that word a lot, but at the end of the day, there are pockets of opportunity everywhere, but there's also sort of speed bumps along the way and places that investors can make mistakes. And you always have a very nice way of simplifying things and in a very complex environment. So yeah, no direct questions from me at this stage.
Okay, excellent. Yes, I'm going to move on just to a bit of a recap of firstly what markets have done year to date and then where we're seeing valuations. In terms of a global construct, we typically lean on 12 building blocks, and those building blocks are all on the left-hand side there, broken between sort of growth assets, which is your equities and your property, and then more defensive assets, typically fixed income and some commodities, etc. The positive, last year, 10 out of the 12 asset classes ended the year negative. The only two asset classes that were positive were the likes of physical commodities and cash. This year we've seen a complete reversal where you've had 10 out of the 12 building blocks positive, with really only commodities being significantly negative at around 7.5% year to date, and listed property mildly negative at down 1.5%. Also complete reversal of what happened last year. So sort of your worst performing parts or building blocks in your portfolio have been your best performing. The likes of your quality equity managers and your growth managers have rebounded quite strongly. If you look at quality up 21%, growth up just shy of 28%. Whereas value, which relatively outperformed last year, is up at this point in time in June, 30, up just shy of 4%. So kind of exactly what you said, the importance of a well-constructed, well-diversified portfolio, as things can change quite quickly. I do want to also mention, though, for those of you that are invested in a pound-based portfolio, the story looks quite different. So whilst dollar-based returns, 10 out of the 12 building blocks are positive, running the same indices in pounds, you're looking at more like 9 out of the 12 still being negative. And that's a function of the volatility and the move in the pound-dollar exchange rate that we've witnessed. We went close to parity on the pound to the dollar, and then in today's terms, we're trading more at around 130 to the dollar. So that kind of, or to the pound, that type of move has been significant. It's unusual, but certainly just be aware of that. So you might be listening to a very bullish conversation here, but I'm referring to dollar returns. If we take that sort of backdrop and we pair it now to a bit more of a valuation forward-looking view, there's a few points to take from the slide on the right-hand side. So before I get into sort of the detail, I just want to unpack the slide in a bit of detail. So the bars represent the yield, the 10-year average yield of that specific asset class. And the black dot represents where current valuations are today. So everything's standardized to yield. So the higher, the better. And what you're really looking at is you should be looking at yields relative to one another across asset classes, but also if the current yield is higher than its 10-year average, it would also suggest that the asset class is cheap. It's a broad brushstroke, but I think it's a nice, easy way of unpacking markets. So a few standouts. The right-hand side of this of the graph looks a lot more attractive, relatively speaking, than the left, relative to its own history, and that's your fixed income segment of the market. So my earlier comment that a lot more to work with in construction of a multi-asset balanced or cautious portfolio, hopefully well depicted there, that the fixed income side of the market is relatively speaking looking cheap. And then if you also compare it to equities, the yield that one's getting in fixed income is now starting to compete with the equity space. Remember, equities have a growth function in there. Each of those earnings grow, where this is your static yield. But be it as it may, I think it's a lot more balanced type environment to construct a portfolio from. And then by and large on the equity, I know a lot of commentators have made a noise about how expensive the markets are. I'm not dismissive of that. There are pockets of the market that are overly priced. But if we take sort of more granular look through, generally emerging markets are pretty well priced. Developed markets are at fair value. Quality is looking cheap, or not cheap, sorry, fair valued, and value is looking cheap. The only part of the market that one could argue is expensive is the growth segment of the market. So we're certainly not only reliant on this when we construct a portfolio, but it is a visual that we think is helpful for clients thinking about long-term wealth creation. I'm going to just go back and unpack some of those comments I made earlier on. But also with that, important to say, okay, well, where we're at right now, what are the important things that we should be looking at on a daily or weekly basis and having discussions as an investment team? And I've jotted a few points there that we think are important right now. First and foremost, the sort of more easy, understandable ones would be central banks and inflation 1 year on. Encouragingly, we've seen inflation in the US come down all the way to 3%. And we've got the Fed talking this week. So those two tie up quite closely with one another. What we're looking for is a continued sort of decline in inflation. Bear in mind, in the 80s, when we had rampant inflation, we had a window of inflation coming down and then had a second leg up. So, whilst we're hopeful and believe that inflation is somewhat under control, we do need to still be paying attention and understanding the data that's coming out, and certainly what central banks are talking about guidance with regards to interest rates. Coupled with that is obviously the potential fallout of growth. So looking at various economic data sets to give us an indication of how quickly or how significantly economic activity is slowing is important. Things like retail sales, the job market, are all considerations that are well debated. To give you guys a sense of what's really transpired over the last couple of weeks and months, there is certainly a feeling of economic activity, by and large, showing signs of slowing down, whereas it's probably held up longer than one would have anticipated up until this last month or so. Corporate earnings outlook, as I mentioned, highly important. We are, from a visibility point of view, in a challenging environment, and we do need to see earnings continuing to at least hold up or price in line with market's expectations. What we don't want is earnings coming out below market's expectations. That would be a risk to the price of equity markets and where they're trading today. Bond spreads, I think I've covered in a lot of detail. I also want to just touch on, and we'll get to the slide more, but I've found that I've had a lot of conversation about the US dollar and in terms of its dominance in the global scene, and whether we are coming to an inflection point where we might see the demise of the US dollar. So I'm going to hold off that conversation now because I've got an interesting slide or two. China continue to pay close attention in that regard as to how they respond to the economic slowdown. There's been a lot of talk of a really big stimulus package coming through from the Chinese authority. Yeah, that would be counter-cyclical to the natural slowdown that we're witnessing. Things like the aging population, the increase in unemployment rate, and the subpar economic growth, where the economy only grew at 0.8 quarter on quarter, are all things that are for now working against asset prices. But just bear in mind that there is that upside risk of stimulus that's been mentioned from this side. And then just lastly, tail risks, very difficult to predict where a tail risk might come from, but the more visible ones would be, as we spoke about, worse than anticipated slowdown in economic activity, a housing market that we've seen a big increase in your bond installments. So these are all things that one needs to just be paying close attention to. But I'm going to touch on one or two of these slides in a little bit more detail. And then the final part of this webinar is just to get into how we are positioning portfolios into the third quarter, both global mandates, and I think some of the viewers on this call will have South African mandates. So I just also want to touch on that very briefly. So on the point of higher central banks, the charts on the right hand side, the top four, just give you a nice clear visual of what's changed over the last 12 to 18 months. You know, the blue line represents inflation in that country, and the black line represents interest rate hikes. Now we can see how quickly central banks, other than the Japanese or the Bank of Japan, have hiked interest rates. But encouragingly, we've also got to a much more closer point where inflation is meeting interest rates. So we talk about a neutral interest rate regime. So yes, we might see a few more hikes, and at the same time, hopefully inflation cools. But by and large, the hard work has been done in that regard. And hence why we're saying we're getting closer to an inflection point with regards to interest rate hikes going forward. In terms of economic growth, you know, when we talk about a global recession, I think we need to just conceptualize what that really means. You know, by and large, economy over the last 70 odd years, the world has grown at least 2% or more. So there's been a few occurrences where both developed and emerging markets, i.e. the globe, has slowed below that 2% mark. I think I mentioned there in 1973, 1981, 1962, 2009, and 2020 are the only 2 of 6 times odd where inflation or growth has fallen below 2%. And at the beginning of this year, in terms of projections, we were right on that needle. So forecasts were suggesting growth of around 2.1%. So I think this is where this fear of an economic slowdown comes from. As I mentioned, as the year has played out, we've probably surprised to the upside to some extent. And there is talk of certain geographies actually potentially missing that recession that was originally priced in. And I think other than the slowdown on inflation, etc., it's also one of the driving forces of why we've seen probably better equity markets, because this sort of change of theme or better than expected outcome has supported the market. Last on the inflation debate and the economic slowdown, a large part of why that forecast has come through is because of the inversion of the bond market or the bond yields. So a very well tried and tested signal or indicator of economic slowdown to come has always been the inversion of the yield curve, as we've spoken about. So in this case, if we're looking at the US 10 and 3, you can just see how inverted that market is. And the gray bars represent every time it inverted the subsequent recession that followed. What it isn't able to tell us, though, is when, sort of how many months. So whilst it's a very powerful predictor of probability, it's not a very good predictor of when. So on the right-hand side, you've got some dates in the past when the yield curve inverted, and then how many months it took. And there's no clear pattern there. In some cases, it was 24 months. In other cases, it was a bit shorter, in 10 months, but on average around 50 months. So we're getting close to that point since when the yield curve inverted. But why does it matter? It matters because when we are in an environment where there's higher inflation and really bad economic growth, the equity market, if we use the S&P as a proxy, tends to perform really poorly. Whereas if you've got inflation and growth, that's not necessarily a bad thing for markets. And so I think it's a bit intuitive. If you've got growth behind that high inflation, you're able to pass that on to the consumer in really drumming it down to simple terms. Whereas if you've got that fallout of demand and higher input costs, that's a lot tougher environment. So if you look, when inflation's tended to be around 2 to 5%, when you haven't had a recession, the market's actually done 12.6% in that year, versus when there's a slowdown in economic activity, the market's been down as much as 18.4% on average. So that's why it does matter and why we need to be paying some attention there. And then on the comment that I made about sovereign yields or credit spreads in the market, I think this is a really nice way of just looking at it. On the left-hand side, you've got sovereign bonds, so there's no credit risk priced into that. And you can just see how much more attractive yields are today compared to what they were just 12 to 15 months ago. So that pickup in yield has been significant, and certainly why it's a lot more attractive. But the charts on the right give you an indication of that credit spreads over sort of sovereign debt. And you can see they haven't really widened much. So that's our argument. And we're saying, why take on the additional risk that comes with high yielding debt, for example, because you're not being compensated, in our opinion, enough. And therefore, we're leaning more towards the sovereign and the investment grade side of credit. And then, I think this is probably my favorite slide in the presentation, because of this debate that I've had to answer quite a few times about, are we seeing the demise of the US dollar? So for context, the US dollar has been the dominant currency around the world for over 75 years. If you take a real long walk down history, currencies do eventually are almost dethroned by another currency over time. But certainly based on the data, I would argue that we're still a long way from the potential demise of the US dollar. And should that actually start to play out, it's more likely to be a slow drip as opposed to a sudden event. And the reason why I say that is the dollar at this point in time is more intertwined into the global financial system than any other currency has ever been in the past. Just to give some numbers to it, around 58% of global reserves are held in US dollars. If we take the example of the renminbi, it's around only 9%. Equally, the Chinese authorities like that control, and that's why there's not as much reserves out there in the world, to keep their currency artificially low. If they open their currency up to the world and really let the forces of supply and demand work out, that's a very different regime to how they currently manage their economy. Secondly, 64% of global hard currency debt is priced in US dollars. Around 88% of currency pair transactions happen in dollars. Between 74 and 96% of trade invoicing, except in the Eurozone, is done in dollars. And then finally, all commodity prices are placed, or key commodities are priced or quoted in US dollars. So that's the point that I'm really getting at. It's really intertwined in the world that we live in. We speak about the potential pullback of the US dollar, and the charts on the right just give you a sense of why we're suggesting that. From a standard deviation point of view, we threw that one standard deviation of strength. And we talk about the dollar smile. The dollar tends to be its strongest either when the US economy is outperforming the rest of the world, or on the other side of the smile is when the world is, when there's fear in the markets. The dollar is weaker when there's a synchronized global growth, which we haven't seen for some time, and hence underpinning why we've probably seen some stronger dollar, a stronger dollar environment than over the last couple of years. Okay, so I think with that, probably the most important thing that we do on behalf of our clients is to take all of this information and put a well-thought portfolio construction together that reflects both opportunities and protects or puts in place some degree of protection for those outside unexpected events in the portfolio. As we've always said, around 90% of the variance of your long-term return is going to come from your strategic asset allocation. So this is critical, and why we spend a lot of time in terms of our portfolio construction. So going into the third quarter, in terms of views, what I'm highlighting here are those building blocks that I've spoken about. The strategic asset allocation is what we would hold long term, and the example we're using here is your typical balance type portfolio, and where we're seeing the world in relation to that long-term strategic asset allocation. So starting with emerging market equities, we've chosen to be slightly overweight that 5% neutral or strategic asset allocation. That's largely driven by valuations. Relatively speaking, as I showed on that previous slide, emerging markets looking cheaper, and we think that coupled with better long-term economic growth outlooks for emerging markets and potential dollar easing are all supportive of emerging market equities. In terms of developed market equities, we've actually chosen to go underweight relative to that strategic view. And that's a function of this potential risk that I speak about, inherent in terms of economic growth. And at the same point, other competing asset classes. So somewhere along the line, to include those asset classes, there needs to be an under and overweight. And we've actually chosen to do that on the developed market equity side. In terms of listed property, we're holding a neutral view there. Very similar to my comment on emerging markets. There's still a lot of risk inherent in the listed property space. On the one hand, you've got this risk of an economic slowdown. You've got higher interest rates currently present, but it is largely baked into the valuation of listed property. We're not necessarily getting that in equities. So we've chosen to go neutral there. On the global fixed income side, we've moved up to neutral on all sort of three of the components. Government bonds, or which I've referred to as sovereign bonds, investment grade bonds, and emerging market sovereign bonds. So whilst it's still a neutral call, and I've spoken quite favorably about fixed income, it's more the direction of where we've come from. We've come from a big underweight to neutral now. And then more about protection in the portfolio, and it's not our base case. We're not anticipating inflation, but it's a position in case we're wrong and in case our view plays out incorrectly. We've chosen TIPS or Treasury inflation protected securities at around 5% neutral. And then lastly, cash. As boring as cash is, money market, short duration types assets are giving you around 5%, which has been a very long time since we've been able to achieve those yields. Also gives us nice optionality in the portfolio. And for that reason, we've actually chosen to go slightly overweight. So probably fair to say a bit of a boring asset allocation, but it's boring by design. I think it's the environment we're in, and we think it's going into sort of that view that I've painted. We're cautiously optimistic that we're able to achieve returns for our clients, but certainly not. We're not going to be overexposing to risk in this type of environment.
Yeah, Rob, from my side, just seeing you going sort of overweight in emerging market equities is interesting, because you go back to your earlier graph and you look at the 10-year return for emerging markets. There isn't much return there.
Yeah.
It's been very benign, which actually, I suppose shows the upside of active managers, because you'll get in now where you see valuations are appealing, but then you also know when to start looking for warning signs to potentially exit if it makes sense to do that.
Yeah, so I agreed. I think, in terms of that component of the portfolio, it is in absolute terms only 5%, our neutral view. So we're talking about the difference between 5 and 8% allocation. But there are points in time, ultimately over very long periods, valuations do count. And we would argue at this point in time, whilst interest rates have been going up, so if you've seen dollar strength, and that's a headwind to emerging markets, that headwind might actually translate into a tailwind into the second half and 2024 in markets.
And just staying on the theme of emerging markets, you mentioned a potential big stimulus package coming out of China. Do you want to maybe just elaborate on that a little bit?
Yeah, look, it's very difficult to know exactly what that stimulus package is going to look like. But at the essence of it, the Chinese government and the authorities are looking to boost consumption. So they're looking to, through various mechanisms, through fiscal and monetary policy, create a more attractive risk on spending type mindset for their really large consumer base, and through that get the economy firing like we've seen in years gone by. We're not going to see the growth that we used to see out of China. I think combination, as I said earlier, that aging population dynamic coupled with just base effects. When you grow 6% on one, it's one thing, but when you're growing 6% on 100, very different. But at this point in time, the reopening trade and sort of the Chinese economy hasn't been growing as we would have hoped, and therefore the authorities are trying to almost restart that engine through some form of a stimulus package, through whether interest rate cuts, etc., or reserve requirement reductions.
Thank you. And I know you've just recently come back from a trip to the UK where you met a number of managers and were there for investment conferences, etc. India, obviously, now is the most populous country in the world. Are people talking about it? At what point in time does it become a separate line item in our discussions?
Yeah, so it was actually widely debated. I think the Indian economy is an exciting potential opportunity for investors. You've got similar dynamics like we had in China, where you've got this really large consumer base, and now the most populous country in the world. What makes India probably a little even better than China is the environment, or the economy is run more, it's a more open economy than what the Chinese economy is. And therefore, I think that's a lot more appealing. The challenge with India, though, is it's still a very cyclical market. So you've got a lot of banking type businesses, etc., that creates this volatility. And we would argue because of that, just buying a passive, you end up buying a lot of those businesses you wouldn't want to own, whereas the active managers are saying they're seeing some great opportunity in that sort of mid-cap space of the market that's not necessarily well represented in an ETF. But yeah, by all means, I mean, we prefer to hold emerging markets broadly and let that manager make that view. But we're seeing most of those managers taking up a bigger interest in India over the last couple of months or so. All right, I'm going to then my final slide is for those of you, as I said, in a South African type portfolio, just to also give you some context as to our thinking of asset allocation. This again is your classic balance type portfolio. As many of you are aware, last year around March, the regulators allowed us to hold a much bigger offshore allocation. It went up all the way to 45%, which is both exciting, but also requires, to my earlier point, a much more active management type mindset, as one has to deal with currency differences and asset class changes over time. But going into the third quarter, for SA equities, we've chosen to be neutral. That's a function of SA equities. If we unpack it between the resource sector, your SA Inc. and your Rand hedges, your resources in your SA Inc. are looking really, really cheap. So we need to sort of bring that in to some extent in the portfolio construction, and therefore that neutral view. On global equities, we're actually slightly underweight, and this was at this point in time when the Rand was trading at around 18.30, because we need to also think about it not only in terms of dollar returns, but how that Rand dollar is going to play out. Take it with some degree of pinch of salt, but our fair value for the Rand dollar is 17.50. So because of that, there's that risk of Rand strength or dollar weakness, and hence that slightly underweight view. For very similar reasons to global property, SA property has issues, but is really attractively priced, and we need to have some allocation there. So we've gone neutral, which is that 5% allocation. Global property, we're not really taking up. Long term, we wouldn't hold it, and at this point, we're kind of holding that view as well. We like SA fixed income. SA fixed income is at a very interesting point where you're able to get almost equity-like returns for a much lower risk profile. So you're looking at sort of CPI plus 5 or 6. So we overweight both bonds and flexible mandates in our portfolio construction. I just want to make clear, it's not a risk-free trade, but it's a lower risk than equities. And we prefer to sort of reflect our opportunity set through that overweight call. And then cash, because we've got this opportunity in fixed income, we're neutral here as opposed to offshore, where we're slightly overweight. And then global cash, we marginally underweight for the same reasons of currency concerns, of potential dollar weakness. So probably a little bit more active compared to our global mandates. But I think by and large, both global and SA, we're finding a lot more opportunity to put a well-constructed portfolio, both from a return, but also from a risk management perspective together than what we were able to do for some time, sort of post-COVID. So with that, Ant, I think I've hopefully covered enough for the viewers to think about. And if anyone has further questions and they want to get hold of me, as always, you're welcome to get in contact.
Thanks, Rob. Thank you very much for that. We've got time just for a couple of questions for those of you that posted questions. Thanks. And if we don't get to them, we will contact you on an individual basis. One question that's come through is regarding the FTSE 100.
Yes.
A lot of our investors have some sort of origin in the UK or spend time in the UK, and it's the top 100 companies in the UK, and yet the growth has been very benign. Why is that? And what type of companies comprise that index?
Yeah, so the FTSE 100 is in a way a bit like a value play, because the underlying companies or the larger weightings in that FTSE 100 are a lot of energy companies, as well as consumer staple stocks. So last year, the FTSE outperformed most markets because of a function of higher energy prices and therefore energy shares doing really well, and then the defensive nature of consumer staples. In a risk-on type of environment, all things equal, an index like the NASDAQ, which is comprises a lot more of your sort of growth elements, your technology type businesses, communication services, outperform. So, I would caution investors just picking an index and saying, well, that's my strategy. At certain points in time and certain points in the cycle, different indices, just because of what the composition are going to behave quite differently. Within that FTSE 100, there are still some great businesses and very relevant global companies. But the UK, by and large, has become, and I think accelerated because of Brexit, probably, and I don't want to offend anyone, but less relevant on the global scene than what it was a couple of decades ago.
Okay, thank you. I think let's leave it there. One thing that's absolutely clear is that the risk is changing in the markets, and you've done a great job of highlighting where the risks are and opportunities are. If anything resonated with our viewers, and if you want to dig deeper, as Rob said, reach out to us, reach out to your advisor. We always say that getting your risk profile right from the beginning is very, very important. Otherwise, that journey is not going to be what you expected, and it could result in expectations not being met, or hopefully exceeded. So have those conversations. Lots and lots to talk about. Rob, thanks for your time. Thank you all for joining us, and looking forward to our next webinar with you.